Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cmoc Group Limited Annual Report. Cmoc Group Limited offers a diverse range of businesses and services across various sectors. The company operates through multiple segments, including molybdenum and tungsten-related products, niobium and phosphorus-related products, copper-cobalt-related products, mineral and metal trade, refined metals trade, and others. The company's primary business involves the mining, beneficiation, and smelting of base and rare metals in several regions worldwide. Its product offerings include copper, gold, cobalt, molybdenum, tungsten, niobium, and phosphate fertilizer. Cmoc Group Limited also engages in trading activities for base metals and molybdenum tungstenic products. In addition to its core business, the company provides various services such as consulting, asset and investment management, enterprise operation and management, technology services, logistics transportation, technical services, software development, and hotel operations. These services cater to a wide range of industries and clients, further diversifying Cmoc Group Limited's portfolio. Cmoc Group Limited market capitalization of $422 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Cmoc Group Limited holds a significant advantage in their industry. Cmoc Group Limited trades at a higher price-to-earnings ratio of 16 times and a higher price-to-book ratio of 4 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation, signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 50% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summaries. On the growth side, several factors contribute to an increase in revenue. Firstly, sales contract terms and conditions play a crucial role in determining revenue recognition. Additionally, performance obligations met at the time of revenue recognition also impact revenue growth. Furthermore, the reasonableness of revenue recognition based on sales prices and volumes is essential for accurate revenue reporting. The increase in inventories measured at fair value has also contributed to revenue growth, with an increase of 77.8% from RMB 2,553,515,666.76 to RMB 5,615,991,396.91. Interest income has also seen a significant increase, growing from RMB 24,528,009.79 in 2024 to RMB 56,215,453.69 in 2025. In terms of external revenue, the Congo DRC business saw an increase of 21.6%, while Brazil and Chinese businesses experienced growth rates of 17.3% and 9.1%, respectively. Sales Company and Wuyi also reported significant increases in sales, with growth rates of 55.4% and 41.5%, respectively. On the other hand, several factors contribute to revenue decline. The decrease in inventories measured at fair value has resulted in a decline in revenue for CATL, while Fuchuan sales of goods decreased from RMB 13,401,145.51 in 2024 to RMB 11,160,652.58 in 2025. Yulu Mining experienced a significant decline in investment value, with a decrease of -24% from 2024 to 2025. Other companies such as Yilian, Xinquang Luomu, and Cmoc also reported declines in sales or services revenue. Countries such as Greece and Canada saw significant declines in revenue, while India, UAE, and Singapore experienced growth rates of 102.8%, 64.1%, and 6.3%, respectively. The company's financial performance indicates a strong ability to generate cash from its operations. The net cash flow from operating activities for 2025 was RMB 20,843,060,708.78, which is a significant positive amount. This suggests that the company is able to cover its expenses and generate excess cash through its day-to-day business activities. The increase in cash and cash equivalents by 12.47% to RMB 30,682.03 million also indicates a positive operating cash flow. Furthermore, the net cash flow from operating activities for both 2024 and 2025 were positive amounts, confirming that the company is generating sufficient cash from its operations. These multiple confirmations across different pages of the report provide strong evidence that the company is indeed generating positive operating cash flow. This is a crucial indicator of a company's financial health and stability, as it suggests that the business is able to cover its expenses and invest in growth opportunities without relying on external funding. The performance of various segments and regions in the company's operations can be summarized as follows. In terms of performing well, the South America segment stood out with notable improvements. In Brazil, niobium recovery rates and phosphate business structure were enhanced, while the Odin mining development accelerated. This indicates a significant boost to the region's operational efficiency and revenue generation. Similarly, the China segment also showed promising results. The optimization of capacity layout at Sandiazhuang and Shangfenggu, as well as the advancement of joint mining operations, contributed to its success. On the other hand, some segments and regions underperformed. In Asia, investing activities suffered a significant decline, with cash receipts from disposals and recovery of investments decreasing by 47% in 2025 compared to 2024. This setback was likely due to various market or economic factors affecting the region's investment landscape. Globally, operating activities also experienced a downturn. Cash receipts from the sale of goods and services decreased by 5.4% in 2025 compared to 2024, indicating a decline in revenue generation across different regions. This could be attributed to various internal or external factors impacting the company's operational efficiency and market demand. Management is optimistic about the company's outlook, citing record highs in operating performance and core product output. They expect the gold sector to become a new growth driver for the company, with plans to put the Odin mining gold project into operation by 2029. The Brazilian gold mines are expected to achieve significant production levels, with 6-8 tons of annualized gold production in 2026. Management is also guiding for strong production targets across various metals and phosphate fertilizer, driven by high copper prices due to tight supply and increasing demand from emerging industries such as electric vehicles and renewable energy. The company's strategy focuses on expanding its gold resources through strategic acquisitions and enhancing corporate value and accountability. In terms of distribution, the company plans to distribute at least 80% of profits in cash if it reaches a developed stage with no substantial capital expenditure, or at least 40% in cash otherwise. Dividends may be distributed in shares instead of cash if earnings are positive and share valuation is reasonable. Overall, management's commitment to transparency and corporate governance is evident as they prioritize disseminating important information to the public. The company's financial activities have been marked by several notable transactions. Firstly, the company has paid dividends to its shareholders in the form of cash. This is evident from various references throughout the document, including page 51 and page 127, which specify that dividends were paid out in both 2024 and 2025. In addition to paying dividends, the company has also engaged in share buybacks. According to page 76, the company repurchased ordinary A shares through a designated account. Furthermore, page 251 reveals that a significant number of shares, 104,930,443, were canceled as part of this process. This indicates that the company has actively sought to reduce its outstanding share count by purchasing back existing shares from the market. There are concerns about inventory buildup and supply chain disruption. The company's inventory levels are significant, with substantial values attributed to raw materials, work in progress, and finished goods. Specifically, the value of raw materials increased by RMB 77,791,560.19, while finished goods remained unchanged. The supply chain is also under strain due to various disruptions. Major mines have experienced supply disruptions, leading to regional supply mismatches. The U.S. has imposed tariffs on refined copper, further exacerbating the issue. Additionally, cobalt inventories in the DRC have fallen outside of the country, forcing smelters to rely on in-transit and historical stocks. This highlights the vulnerability of the company's supply chain to external factors. The situation is compounded by specific issues at key locations. For example, the Cmoc copper cobalt mine in Congo, DRC, has raised concerns regarding non-current raw materials. Meanwhile, consumable biological assets in Brazil have decreased, indicating potential problems with inventory management and supply chain resilience. That concludes the financial summary for Cmoc Group Limited. Feel free to comment below, and I will be happy to answer them when possible.